According to Jenermy Grantham and other stock market commentators, the US stock market is currently in a bubble. But is this true, and should investors be worried? In this video I look at the current state of valuations, consider why this is important, but I also consider whether we should reduce our US allocation as a result and how to go about that in practice. I also look at the end of the video about what might make the bubble pop. This video is sponsored by Freetrade, the commission-free investment platform which is revolutionising the world of investing in the UK market. Let's begin by looking at why the US is so expensive right now. And yes, the US is expensive. If you look at the forward price to earnings multiple, that's the number of dollars people are willing to pay for every dollar of future profit forecast for the S&P 500 stocks. That's currently at pretty high levels. People are willing to pay $21 for every dollar of future profit. It's not as high as it was in 2020 when people were willing to pay $23 for every dollar of profit, but a more normal multiple might be something like 15, 16 or 17 times forward earnings. And this measure is mean reverting. If you look at the 5-year average, that's the dashed green line here, you can see that we're well above it. That would be a multiple of 19 times. And the 10-year average is even lower. That would be a multiple of below 18 times. So when this multiple is high, usually it means lower returns in the future. Now after the tech wreck in 2022, a new narrative came to the fore to save the US market, and that was essentially the story of AI. The major beneficiaries of this narrative were many of the mega-cap tech stocks. So the Magnificent Seven, or as it described in this graph from Yardeni, the mega-cap 8. Now if you strip out the mega-cap 8 from the overall valuation of the S&P 500, that takes us from a 21 times multiple all the way down to roughly 18.7 times. And if we just look at the mega-cap 8, you can see their valuations are way above the average for the S&P 500. There the multiple is just under 30 times. So really it's this narrative which has pushed up US valuations, and this is very much dominated by just a handful of stocks. And it's by no means true that all of the US market is expensive. It's just that dominant small handful of stocks which is expensive. So if we break it down by sector, you can see that yes, technology, industrials, healthcare are all quite expensive on this forward price to earnings multiple basis. But the unloved sectors like energy, financials, utilities are all much more reasonably priced. So if you're looking for value in the United States, you can certainly still find it. But if you buy the US as a whole, say an S&P 500 tracker or even a global index tracker, then you're going to be buying stocks at a pretty high multiple. I think this visualization from FinViz is also really useful because it shows you squares in proportion to the market cap of a company. So you can see the Magnificent Seven here very clearly, and the red shading shows you the stocks which are most expensive. So Microsoft is at a 32 times multiple, Nvidia at 30 times, Amazon at 33 times, and even after the big sell-off in its share price, Tesla is the most expensive one according to this measure at almost 44 times forward earnings. So you can see why people are worried. They're worried that this is an exuberant bubble and that these stock prices have been pushed up beyond all realms of sensibility, certainly above their fundamental profit growth. And we're already starting to see some of that euphoria fading. Some of the Magnificent Seven are no longer so magnificent. So if we look at year-to-date returns, you can see that Tesla's fallen by around 30%, Apple by about 8% as sales in China disappointed, and Google and Microsoft have only made double-digit returns. So maybe now we need new acronyms like the Fabulous Four, the Terrific Trio, or the Dynamic Duo. You can see how Nvidia and Meta are very much dominating the return table so far this year. So the narrative is fading a bit, but it's now becoming more concentrated in just a few last hopeful stocks. The big worry, of course, is that everything is going to go into reverse and that there'll be some kind of reckoning. And because the US market is so dominant globally, then index investors are understandably scared. Today's video is sponsored by Freetrade, the UK commission-free platform that's revolutionising the world of investing in the UK market. Freetrade offers you over 6,100 US, UK and European stocks, ETFs and investment trusts. With over 1.5 million users on board and having won the best online trading platform at the British Bank Awards 5 years in a row, they're a well-trusted trading platform. With free trade, investors have the opportunity to manage their investments in a tax-efficient way by opening a stocks and shares ISA. For those looking to consolidate their retirement savings, free trade offers a self-invested personal pension or SIP, so you can bring all your old pensions under one roof. Free Trade stands out as the only UK platform to give you access to UK Treasury bills that start from a minimum investment of £50. These instruments are backed by the UK government and so are widely regarded as a low-risk investment. As I make this video in the first week of April 2024, these instruments offer a yield to maturity that surpasses the current inflation rate. But that's not all. Free Trade is offering our YouTube audience a free share worth between £10 and £100. All you need to do is to join the platform and fund your account with at least £50. The free share will be added to your account within 7 to 10 days of funding. Ready to claim your free share? Head over to freetrade.io/PensionCraft to benefit from this offer. You can also find this link in the description of the video. So why does valuation matter in the first place? Well, Jenermy Grantham is always a good source of information when it comes to why we should be worried about the stock market. Some people describe him as a perma-bear, but I don't think that does him justice. If you look at his essays on the GMO website, they're actually really well informed and interesting, and also quite nuanced. He makes some really good points in the latest publication from March 2024. One point which he made, which I find really interesting, is that with the Shiller multiple at 34 times, and that's where we are roughly at the moment, there's never been a sustained US stock market rally. His other point is a macroeconomic one, which is when we're at full employment, and the US by almost any measure is well beyond full employment right now, there's also never been a sustained stock market rally. Now for premium members of our website membership, we have this valuation monitor, which looks at this Shiller Cape multiple. And as Grantham says, the current level of Shiller's Cape is very high. In fact, it's been cheaper 98% of the time, going all the way back to the 19th century. Another measure he's come up with is the excess Cape yield, which adjusts for interest rates. And there again, you can see that the US is expensive. Cheap and expensive here are flipped the other way up. And by this measure as well, the US looks expensive. In fact, it's been cheaper about 3/4 of the time. So if you do want access to that tracker and other benefits of membership, just go to our website, PensionCraft.com. So what we can do is look at the total real return of the S&P 500 following a certain valuation in the past. And that's what you can see on this graph. To the right of the graph, you can see high valuations. To the left, you can see low valuations. And as you'd expect, when valuations are high, you see lower real returns. And this tends to be most informative at extreme valuations, which we're at currently. In fact, if we slice the distribution based on today's Cape multiple, we'd expect a negative total real return for the S&P over the next 10 years. There are big error bars around that, of course, but still, it's not looking great for the US market, given valuations where they are now. So should we go underweight the US market? And if we decide to, how can we do it in practice? Now, personally, I don't do this. I don't change my regional allocation based on valuations because I think I'm unlikely to get it timed correctly. And often when the US is expensive, it stays expensive for a long period of time. But if you're worried about US valuations, how could you go about cutting your US exposure as a global equity investor? If you just buy a global index, of course, everything is munged in together and you don't control the weights. So an alternative approach is to split your global allocation into regions. You actually don't need that many funds in order to reproduce a global fund. In fact, you can do it with 4 ETFs quite effectively. You need one for the US, that would make up about 50% of your allocation. Europe, including the UK, would make up 27%, emerging markets about 14%, and Japan would make up about 9%. Now, once you have this breakdown, you can dial regions up or down according to which ones you think will underperform or outperform. So let's say that you wanted to dial back your US exposure because you think the US is expensive and will underperform. Let's say you dial it back to 40%. All you do then is to redistribute that 10% amongst the other 3 funds. So Europe would go from 27% to 32%, for example. What I'd warn against is removing the US altogether. Don't forget that the US is expensive because it's a really successful market, and excluding it altogether, I think, would be a huge mistake. The US has made up about 50% of global stock markets for around a century, so that's not unusual. So what could pop the bubble? And for it to really be a bubble, of course, it has to pop. It's quite hard to identify bubbles when you're caught up in the euphoria. It really takes a market shakeout to look back and say, yeah, that was a bubble. So what could it be that triggers a popping of this bubble if it is a bubble? Personally, I think the most likely cause is going to be something geopolitical. So for example, if you look at comments from Donald Tusk, the Polish Prime Minister, he says we should already be preparing for war. He says that Europe is in a pre-war era. I don't want to scare anyone, he says, but war is no longer a concept from the past. It is real. In fact, it already started more than 2 years ago. And here, of course, he's talking about Russia's invasion of Ukraine. So could this Ukrainian conflict escalate into the rest of Europe? It's certainly possible. And that would definitely, I think, pop the US stock market bubble. China's also been ramping up its military spending. And of course, that raises the possibility of a conflict, although hopefully it won't come to that. But if China were to be locked out of global markets, I think that would be a really serious problem for the global economy. And that's because of its huge size and interconnectedness with the rest of the global economy. So if, for example, there was an invasion of Taiwan, then I think that would be a huge problem for global markets. And going back to previous bubbles, a good old-fashioned accounting crisis is also a fairly reliable cause of a big stock market sell-off. Enron and WorldCom were the big ones in 2000, but of course this time around, maybe it would be something like a tech company misstating its earnings. It doesn't even have to be misleading on purpose, it just has to be a mistake, an accounting mistake. But if investors have been misled, that could lead to a big re-evaluation of the whole story about AI and profitability of tech. And Grantham makes this point in his most recent newsletter. He says every technological revolution like this has been accompanied by early massive hype and a stock market bubble as investors focus on the ultimate possibilities of the technology, pricing most of the very long-term potential immediately into current market prices. And he cites the example of Amazon and the story about the internet in 2000. So yes, the internet was truly revolutionary, and Amazon ultimately became hugely dominant in the internet retailing space. But this came after a huge rally initially leading up to the 2000 bubble, which then popped and then left Amazon in a lurch for over a decade. So it took almost 11 years to reach its previous all-time high, if we consider inflation. Of course, since then, the returns have been incredible for Amazon, but it did come with this huge hangover period after people overpaid for the stock with the early initial enthusiasm. A lot of the future upside was priced in very quickly, and then people paid the price as earnings didn't keep track with that enthusiasm, at least initially. So I think it's undoubtedly true that the US is currently expensive. The question is, what should we do about it? As I say, personally, I don't do anything about it. I've got almost all of my wealth invested in one global equity fund, and I'm just going to stick with it. But if you've got a lump sum to invest and you're nervous about investing, then I think drip feeding might not be a bad idea at this point, given that we're at probably the top of a euphoria phase. But if you're still in the accumulation phase and still drip feeding into your portfolio, then I think a crash wouldn't necessarily be a bad thing. It just means you'll get to buy stocks at a lower valuation. Now don't forget our offer from Freetrade, who's sponsoring today's video. To learn more about that, just go to freetrade.io/PensionCraft. You'll also find that link in the description below. And, as always, thank you for listening.